Peter, my question for you is, in your worldview of high quality investing, how important is diversification in your mind?
It's like what Buffett said, right? Diversification makes no sense if you know what you're doing. So what I usually say to people is, when you start out, in the beginning, you will always make plenty of investment mistakes. So in the beginning, probably makes a lot of sense to diversify your portfolio globally, per sector, and so on. But the more experience you get, the more you can basically take convictions in certain companies. It's like Warren Buffett made all his wealth via 10 stocks. You have Nick Sleep, who basically invested in only 3 companies, Amazon, Costco, and an undisclosed one. And that's really how you can make a difference as an investor. So for me personally, I try to invest in 15 to 17 stocks. But it's also
15 to 17.
Yes, exactly. But it's also, like already mentioned during the presentation, we are fishing a bit in the same pond, meaning you want the best companies in the world. You are really strict. So worldwide, there are 60,000 listed stocks. When I use the criteria I want to use, well, less than 100 remain, basically. And out of those 100, there are plenty of companies that trade at such a lofty valuation level. For example, for me personally, Constellation Software is a company I would love to own, Copart as well in the US, but they are so expensive that you don't want them. So you want to pick the companies in this list that trade at reasonable valuation levels. That's why you need to be strict, because only a few fit all criteria.
That was kind of mean of us to leave Peter out.
He went for the water, and I said, hey, man, we can cover any topic you like. He's like, I'm going to kind of stick to this investing thing. And so I was like, let's give him the water.
Woo. All right, well, that makes a lot of sense. I understand what you're saying. My favorite situations are where you have a company that has been very, very poorly run, and then you have a new management team that comes in that understands what we understand about capital efficiency and about running the business the right way. Unfortunately, the very best investment I probably ever made in my life was buying Hovnanian, the home builder, in 2018, 2019. And I think it's up about 3,200% since then. And I tried to get all of us into the deal when the stock was still low, it was maybe in the 30s. And I got scared out of it because of mortgage rates. But that was a business that was very poorly run. It was heavily indebted. And then they got wise, so they sold off all their real estate, and they started running the business using the NVR model. And now they're making progress, but they're at probably about 80% of all their builds are from option land as opposed to owned. And NVR, of course, is at 99%. They're the industry leaders. And I've watched the other home builders begin to spin off their real estate into separate REITs. I don't know if you've seen that or not, but I think Lennar just did it most recently. And I think it's going to make those businesses way better businesses. So you could see a re-rating of these stocks where they've always traded at 6 or 8 times earnings. You could start seeing those good home builder stocks, NVR, Lennar, DH Horton. They should, as a capital efficient business, they should be trading at 25 to 35 times earnings. So you can see a big re-rating in the housing stocks. And I'm not quite sure if you guys get this or not. You may not know as much about economics as I do. Ha ha ha. But Kamala's plan to give everybody $25,000 to buy a house with is, of course, just going to make the home prices go up. It's not going to make it more affordable, dimwit. So, anyways, I think that's a very interesting structural change. And when you see those kinds of things happening, if you're an investor, you should pay attention.
Porter, let me ask you a question. And I know we've talked about this with Keith Kaplan. He was just up here with trade stops. Had you instituted the trade stop software for the Hovnanian, would that have kept you in that trade?
Absolutely, yeah. Yeah.
It's also, maybe to add there, what I think is...
The good news is my wife didn't sell it. That's the good news.
What I think you guys are doing well is, for example, what you mentioned, okay, you need to look for the turnaround stories. For me, that's not the case. I want to basically buy companies that have already won. But in the investment world, well, there are multiple roads that lead to Rome, basically. Not sure if that's a saying in the US.
Yeah. I hear what you're saying, Peter. And I want to be really clear about something. I'm not suggesting you should invest in turnarounds, because they often don't. Mm-hmm. I'm saying that when you have a good business, when you have a winning business that's been in business for 40 years and really knows what it's doing, and they make a structural change to permanently increase their capital efficiency, it's a great time to buy. McDonald's, by the way, did the same thing between 2011 and 2014. They got rid of virtually all of the restaurants that they owned at the corporate level, and they franchised even a higher percentage of them out. Used to be McDonald's was about 60% franchise and 40% corporate. Now it's about 90% franchise and 10% corporate, and that's really made a big difference in the capital efficiency, and so therefore in the multiple. That's what I'm talking about. That's not quite a turnaround situation.
Exactly, but what I wanted to add as well is some people like biotechnology companies, some guys like distressed debt, that you have multiple options available. And also, everyone knows the famous saying, well, cut your losses and let your profits run. But you can also invert it, turn it upside down, and just look at the companies that have already done really well in the past, because winners usually tend to keep on winning and the other way around, and just to stick to those kind of businesses, and that's exactly what I want to do. But you are right, when you, for example, there are plenty of studies about 100 baggers, so companies that went 100x, and those are usually the great businesses that are still undiscovered, so they trade at whatever.
He spoke at our conference last year.
Really? Yeah. So that's amazing. So then you have the multiple expansion and the earnings growth, you go to the intrinsic value, and that's really where the magic happens and where the snowball keeps rolling.
Yeah, and if you, we've been talking a lot about this in the journal and in the editorial, but when you realize that about 7% of all the equities derive 98% of all the returns, you start really trying to figure out which company is going to be a power law winner. And if you start doing that even a little bit better, you really will improve your long-term performance. Because what you most want at an investment is to not have to sell it, to let it compound for decades, and then to provide you with a great retirement through its dividend payments. And I watched my dad do that. He worked for the Coca-Cola company, and he reinvested as much money as he could every year from his salary into the matching Coke stock, and they kept increasing the dividends every year. So by the time he retired, he was making more in dividends than he was making in his salary. And I noticed, I just saw on Twitter today that McDonald's just increased its dividend for the 48th year in a row. I mean, that's a growth stock. And it's just funny how people dismiss it because they don't understand what an incredible business it is.
Porter, on the flip side, Miles, your brother, with GE, how has he done reinvesting in that stock?
Yeah, so the other sad story is my brother is a senior engineer at General Electric, which is one of the reasons why I've made it such a focus, because it was being so poorly managed and his entire life savings were pretty much destroyed. So you got to make sure you're in a power law winner, not a power law loser.
I mean, you're the smart one. Ask him questions. What else do you want to know?
I'm the smart one since when?
You're always the smart one. It's not Aaron and Co. It's Porter and Co.
Peter, I'm interested in what you did and as a professional in finance. You said that you worked in finance before you started this business. What side of finance did you work in, and what was that experience like?
Yeah, basically, in short, I always was interested in stocks, so I started investing at the age of 13, 14. So that's when it started for me. Then I needed to go to university and basically needed to make a choice because I also had a passion for teaching. So I was in doubt, should I go teach or should I go and follow my passion for investing? Followed the passion for investing, did an MBA. And then after that MBA, joined the industry. Well, I worked for an asset manager in Belgium, local asset manager. So with 20 people, we managed around 4 billion. And I was involved in managing an equity fund, and to be more specific, a climate equity fund. The fund had around 250 million in assets under management. But I guess two things. One, climate equity fund. You have a lot of plenty of people talked about it already, green hydrogen, for example. But when you looked, and it was 2021, when you look at the fundamentals of green hydrogen, and to be more specific, green hydrogen stocks, the green hydrogen stocks, to take Plug Power, for example, they needed to have 30% market share by 2050. They needed to operate at EBIT margins of 15% and to grow by 20% per year. But that makes no sense at all, because when green hydrogen would succeed, and I would leave that in the middle for this point in time, all the traditional oil companies would join as well. But then your employer comes to you and says, you need something in green hydrogen. You need to tell an interesting story about green hydrogen during roadshows. So I had the feeling, it's way more important to sound interesting than to be interesting.
There's a reason why the world's best informed investors read my daily journal. Subscribe for free at portersjournal.com.